welcome to NZ Funds Connect. I'm James Grigger, Chief Investment Officer for NZ Funds, and every week we're taking the opportunity to bring you a variety of perspectives on financial markets, financial advice and developments here at NZ Funds. It is Monday, 18th of October at 9 a.m. We believe now may be the best time in recent history to invest with an active approach into shares. A reflation of the global economy driven by vaccines, economic stimulus and continued support of monetary policy is contributing to greater market breadth. Mark Brooks and Andrew Curtain, portfolio managers here at NZ Funds, are here today to consider which companies we think will benefit from a broader reopening of the global economy. But first, I'm very pleased to welcome Tim Malloy, CEO of NZX-listed Geo. Sydney-based, so Tim, apologies for the early morning start. Tim is an experienced senior executive and internet entrepreneur. Tim built Exonet Business Software, a New Zealand-based software platform, before selling it to MYOB in 2007. He then spent many years in senior roles at MYOB before participating in the successful private equity buyout and exit of MYOB to Bain Capital for Australian $1.2 billion. Geo provides software platforms for tradies, field and home service businesses. Demand for its technology is growing quickly as the global mobile workforce expands. And just to note, NZ Funds participated in Geo's recent capital raise to help accelerate the growth strategy in New Zealand, Australia and abroad. Tim, thank you very much for joining us this morning. And look, it's lots to cover given what's going on in Geo and just the wider context of technology, both in New Zealand and Australia, but also globally. But for a start, it'd be great just to learn a little bit about yourself. So perhaps we could go back to the beginning, perhaps, and go through, how you got to be in sort of the middle of a pretty exciting sector, and then perhaps we could then touch on, more intimately around Geo and what's going on with this exciting company.
Sure, James. Thank you. And thank you for having me on your podcast. I really appreciate it. James, I'm a Kiwi. I grew up in New Zealand. I grew up in Havelock North in the Hawke's Bay area, one of a large family. So we were kind of integrated like a lot of people were back then, somewhere between school and farming. And I went to university up in Auckland. I had an opportunity to get into high growth businesses very early on in my career when I became, in my 20s, marketing manager for Kentucky Holidays, based in the UK. And we didn't really understand the boundaries at that point about what you could and couldn't do. We just imagined a world that was a better world for people who wanted to travel. And we did a lot of innovative things. I learned a lot during that early phase about if you're going to do this sort of stuff, get onto it quickly and execute viciously. And from then it sort of transitioned across into technology as another high growth world. When I came back to Australia, I was married at that stage and came back to Australia and I started to get involved in IT companies. My first experience was with a company. We were doing time cost billing systems for accountants and practice. So, and again, similar sort of thing. How do you take a small business as it was at the time and accelerate it by through some core principles? And some of them are things like really, really listening to the customer, the obvious sort of stuff as well, but a lot of it as well as around how do you organize a team and galvanize a team around a light on the hill approach to where we want to go. So that's kind of how I got into this. I was running the M&A team for a business called Solution 6 during the height of the previous tech boom, and that business bought Exonet. And at the end of the tech boom, I bought that business from Solution 6, and it was a classic little business in, really good Kiwi business running out of Auckland, had fantastic customers around the place, good platform, but not necessarily a good business at the time. So my thing in life is trying to find businesses where they've got a good platform and a good market, etc., and then turn them into good quality businesses and get good quality returns for the shareholders.
That's we could probably have a whole hour talking about Kentucky, because that would have been a lot of fun being in London working for Kentucky at the time. But for those of us that did those tours and your pretty amazing experience to get your sort of post-university or school life kicked off. But anyway, perhaps we won't digress down that route now. But I guess early on in this sort of technology space, and you just pointed it out then that sometimes it wasn't really the technology that led to success. The technology was great, but it was actually turning these ideas into businesses. And we'll touch on Geo in a bit, but is that what you find? It's while we always talk technology, actually there's a magnitude of ideas out there. It's how to monetize it and how to grow them, and rather than the actual technology itself. Is that fair?
Yeah, that would be true, James. Even if we go back to Exonet, which the Kiwi company, client-server technology, but it was working really well. We had some very big customers like Glengarry's in New Zealand, etc., who were running their back office system using our stuff. So the technology itself has to be modern and reasonably up to date, but it doesn't have to be way out there. Even Geo today is a good example of that. We've got a good quality platform, the underlying technology is good, but actually our tradies who use our stuff, they don't really care about that. What they really want to know is that it works. So then the focus becomes, how do you satisfy the customer's need, and how do you really, really understand what their pain points are and what role you play in that, and to what extent you need that technology to do that. That then becomes the real focus, and there's a lovely virtuous circle there of getting inside the skin of the customer and really understanding what they're about, and that brings back into the technology what you need to do, and it kind of elaborates your roadmap for your technology by doing it that way, rather than thinking, I've got a bunch of technology and what can I do with it.
So then I guess the journey goes to MYOB, where it's or perhaps it's when you got there it was a bit smaller scale, but this is starting to get real size in terms of its the number of customers and just the size of the business. Big difference in that environment from Exonet?
Yes, it was, because Exonet was a small, less than 30 people, entrepreneur type business, everybody doing what they need to do, etc. You could see everybody in one room. MYOB much bigger, 900 people, $1 million of free cash flow a day. And I arrived at MYOB because I sold my Exonet business into MYOB. Myself and another Kiwi called Bruce Carr, we sold it into MYOB. And I teamed up with Tim Reed, who was the CEO at the time, because Archant Capital had just bought MYOB for $480 million. And we took that business on a 2.5-year journey and sold it to Bain for 1.2. So it was a terrific uplift in value for the shareholders during that period of time. And it was different in the sense that it was bigger, but there was still a whole series of guiding principles going through that, which was focus on the stuff you're good at, cleave off and get rid of all the stuff that's a distraction, really, really get good at the thing you're good at and do that very, very well and execute well on that. And that's exactly what happened in the period that I was there with MYOB. We sold a whole lot of the overseas operations. We were competing against Sage in the UK or Quicken in America, for example, and really focused on the Australian and New Zealand market under Tim Reed's guidance, and that proved to be a winner. It allowed us to slim down the head office at the time, but it was also a time when it was a transition from who will all recall when the software was being delivered on CDs. So there was a big warehouse right next door to the office in Victoria and Melbourne that every single day a big truck would turn up and pick up all the packages of software. And it was at the time when Xero was coming along as well, saying, of course, that cloud was the next big thing. And of course, Xero proved to be right as well, that cloud was the next big thing. But yeah, you're right. It was a much bigger business. We were dealing with bigger ideas in the business as well about how you deal with people, how you deal with organization ability, how you think about innovation in a business that's a big flywheel business where you don't really want to rock the flywheel at the $1 million of free cash flow, but at the same time too you want to have an innovation streak going on. So there was a lot of really interesting things that we were doing during that time while still making sure that the core business was running really, really well.
That's an interesting point about the flywheel, because you look at MYOB now and it's still a really successful business, but they've got this sort of small company called Xero at their heels, and I'm not sure what the market share differences are now, but that flywheel really had to be keep pumping, but also a lot of innovation to keep up with some of these new entrants, as well as the ones in the UK and the US who are also developing cloud-based solutions. Any cheeky question, but any thoughts on winners, losers, or perhaps how that market evolves?
It's going to be interesting how that market evolves. It's like a lot of these markets, it's stratified, and there's the SAP and the Oracles right at the top. There's quite a range of products like XNet in the middle that MYB now owns, and then sort of towards the bottom end there's the MYB, Quick and Sage, and Xero. Xero have been incredibly innovative in tying together the bookkeepers and the accountants with the small businesses, and effectively getting a way that helps the small business actually do their books, because they've got the bookkeepers of this world looking after their business. So they've been very good like that. And of course, as they've grown up, Xero, they've been able to innovate and put more and more features into their product as well. So the product itself has grown with their customers. So it's quite competitive. How will it play out? Who knows, really? MYB have been innovative at the same time too, but they have tended to be slightly bigger customers than the Xero customers, but that's changing. Xero are climbing up into that space. It'll be, Roger and the team have done a very good job there in making that little Kiwi company out of Wellington a global name.
Yeah, absolutely. Yeah, it's a great success story, but I guess at the same time, never underestimate what I don't know if it's $1 million now, but $1 million of free cash flow a day that some of these companies that have been around for a while still are able to generate.
That's right. Exactly.
So I guess from there, moving to Geoterm, look, with just your experience and background, I guess from that point, you could have gone anywhere really in terms of different types of challenges within technology, whether it be a new startup or a company that needed some more direction. So perhaps tell us about what you saw in the opportunity, or maybe some background into how Geo started and established, and then how you sort of saw it and then started getting involved.
Sure. So Geo's been around quite a while. It's been around for about 10 years. It's had raised quite a lot of money at one stage, about $10 million, and went on quite a strong marketing splurge at that stage. Was probably a market leader for quite a lot. It still is in its own way, but it kind of lost its way in the last 4 or 5 years, is my sense. And then Roger Sharp at Northridge Partners got involved in the business and did a lot of background work in terms of the board and the capital structure and funding it, etc. And then Roger and I have been friends for a long, long time, and I popped over to Queenstown one weekend to just have that conversation with him about what would you do with this asset and what was the potential. And we started sitting there. It was a classic. We had a really lovely bottle of Otago Pinot, and we'd just been mountain biking for the afternoon, and we were sitting around just doodling and saying, well, look, there's a big market here of tradies. There's around somewhere, so I'm just looking at my numbers as I talk, but there's around 250,000 trading businesses just in Australia and New Zealand, and they're employing about 800,000 people, James. So, and most of there's a range of companies like ourselves who are working in this market, but our market shares are all small, which says that it's a nascent market. In other words, the market is still not really using technology to do the core bits of their business. And we estimated at that stage that probably 65-70% of the market wasn't using that sort of technology. They had Xero in the background, but they didn't have the bit of software that allowed them to do quotes, set up a job, allocate the job to a calendar, make sure that the person turned up at the time they said they were going to do it, have checklists for the job, be able to produce an invoice and then take the payment and have that payment get reconciled back through their Xero. So that core bit is the bit that we were looking at and saying, if you're a growing tradie and you've started to get more than one vehicle on the road, you've got 2 or 3, then your office administrator can't do it with paper anymore. So we sat down in Queenstown and said, there's a really good opportunity here. And you're right, it's the smallest business I've ever run. And in that sense, I'm happily dissatisfied being here because, but the opportunity is to make it a much bigger business. And that's what we're doing. We've had some, we had to get the business really reorganized and COVID came along, so we had to get it really reorganized. we'll all recall those early days of COVID. Everybody was spooked. Everybody cut marketing dollars. The people took 20% pay cuts during that period of time. But it allowed us to really reorganize our business. And that's kind of the background to how I got there. And then the question probably that followed is, well, what did we do once we got there? And we did all the normal things. We sat down and said, okay, let's really understand our customers. Let's really understand not just that there are 250,000 of them and 800,000 employees, but what segments are they? What are cleaners like? What are plumbers like? What are builders like? What are carpenters like? What are each of the segments? What is the differences in the way they work and how they work? And we use that to do two things. It defined our product roadmap on the one hand, but it also then defined our go-to-market by us being able to say, we can focus directly on the customer that we want to talk to. So, for example, cleaners. During the early stages of the pandemic, cleaners really accelerated. People were laid off work, the barriers to entry to be a cleaner are low, and people were at home and needing their houses cleaned. So it was a perfect match for cleaners to be a thing. So we were able to say, we know cleaners, we know how to talk to them. When we rifle shot them with our digital marketing, they come to a landing page and our salespeople speak the language of cleaners. And doing that, we're able to drive things like our cost of leads from north of $200 to just only slightly more than $50 a lead, just because we were focused on it. So we did all those sorts of things in the business when we got there. It's a playbook really, and it's pretty standard. It's just really, like I said, it's a matter of just doing it well and doing it properly.
So then, sounds like a really good period of, and maybe I was going to say of writing the business almost, and then COVID perhaps, although it hinders some things, helps in terms of makes you really focus on costs and where that capital is being allocated. Now that we, I'm going to say we, perhaps more you, because you're Sydney based and a little bit more, have a little bit more momentum in the economy reopening. But outside of Auckland, where I am, the New Zealand economy is a lot more opening up, or outside New Zealand, Auckland and Waikato. So from there, then it's around growth but it's not, and what we saw as an investor, as NZ funds looking for investment opportunities in these, I guess there's a number of New Zealand growth opportunities, but actually few and far between when it comes to listed markets, and we were really attracted by exactly what you said, the total addressable market for what the technology is aiming at is massive.
Yeah.
But it's not just about New Zealand and Australia. So you raised capital just recently. What's the plan from here, and what do you plan on using the capital for, and what markets, and how you're going to do it from where you're sitting, given it's a global perhaps expansion?
Yeah, sure. So the context for answering that question is really about thinking about businesses like this in three phases of turnaround, if you like. The first phase is the one I've just described, which is get organized. The second phase is around growth, and that has two halves. The first half is prove that you can grow. The second half is accelerate that growth. And then the third phase is optionality. And by that I mean, we will have a better share price. We've got really committed shareholders at that stage. And we can start to say, what else are we good at, and what's allied, and how can we accelerate the enterprise value of the business doing that? So we're right in the middle of the second phase at the moment. And so, yes, you're right. We went out and raised capital, and that was really positively viewed by the market, yourselves included, James. Thank you for that. We intend to use that money for this acceleration phase. So we're well established in Australia and New Zealand, and we watch COVID, and we watch the bumps about when COVID comes along. But interestingly enough, the business is quite resilient to COVID. Tradies in the main are still working, and the lockdowns, the quite tight lockdowns, usually are only going on for a period of time. So we see a dip in the number of jobs on the platform during that period of time, but we don't really see too much of a dip in tradies walking away from the platform. Those who need to, because their business is hurting, we work closely with them to make sure they stay as a customer and then come back again when their business comes up. So that's kind of our Australian New Zealand market. We're a platform, and a SaaS platform, so we can be available anywhere. So we've recently just started getting involved in the UK market, and the metrics that we've had in the Australian New Zealand market, the cost of a lead coming in, the conversion rates, how long it takes, etc., are almost the same in the UK market is our experience. The challenge we have in the UK market is to be there. And I put that in inverted commas deliberately because we don't necessarily physically have to be there anymore. It's not a case in these new markets of climbing on an aeroplane and setting up an office and employing people and then working out in the market and perhaps 6 months later starting to get people. We can turn on our digital marketing in the UK as we've done already. We just have to make sure that we've got people working that time zone so that we appear to be local. And we're as local to the UK as we are, say, for someone in Hamilton. We don't have an office in Hamilton, but we're available on the end of a phone to talk to someone if they want to get on board. So that's been really successful. We already have around 16% of our business comes from overseas, and we haven't really worked at that. And about half of that, or 8% of our business, comes from the UK. So we've got quite an established base there. It's small, but an established base there already. And we're enjoying it. We're liking it. And that's how we'll use a fair chunk of the new capital for market expansion. But at the same time, we'll use some of that capital to accelerate the product roadmap. There's always a sense with these products that they would get to a point where they're done, and they never are. The customers are always asking for more things, and there's a natural contract with the customers in a SaaS world where they're paying us a monthly fee. The natural contract is that we have to stay relevant to their business needs. As their business needs evolve, so does our platform have to evolve as well. So we have a product roadmap, and we'll apply some of those funds to do that, and that's the virtuous circle. If we're producing a really good platform that's relevant to their business needs, then the money we're spending on acquiring more customers will be well spent because they'll stay with us. And that's an important part too, is that we've tried to run this business, James, or we are running this business through metrics everywhere through the thing. And it's a really simple story. We have a large market. We know how to go and get those customers profitably. Our LTV to CAC, which is our lifetime value to cost of acquisition ratio, is above 3. And 3 is about the break even. In other words, if you're acquiring customers with an LTV of 3 or greater, then you're acquiring them profitably. So if it's a big market, we know how to get them, and we're doing it profitably, then we should do more of it and employ that capital. And we know how to therefore get a return on that capital when it's employed like that.
Well, one question that I'd love to ask, and there's no one answer really, but NZ Funds, the firm, we're looking to grow our business, and we've been successful so far over the last couple of years, and coming up with different strategies, mostly partnering with people on, for example, this webinar to help us look at that growth. But when you look abroad, say the UK, there's 60 million people, and lots of different ways you could grow, and it's not a matter of raising some capital, putting a couple of ads on, in between Coronation Street, and the customers will come. How do you even start thinking about growing into a market like that and getting known amongst the right part of that 60 million people? I mean, it's attractive because of the size, but it's somewhat daunting in terms of the how. What are the different things you do to grow into those sorts of markets?
So one of the things we did in the Australian New Zealand market, James, is the segmentation study, where we said, how many cleaners, what are the attributes? How many carpenters, what are their attributes and dynamics? And we did exactly the same for the UK. We presumed that the UK would look a lot like Australia and New Zealand. We've all lived, a lot of us have lived there, as you know, and we kind of get it, and it's talks more based, etc. But we weren't arrogant enough to think that it would be exactly the same. So we did that study first of all, and then the second bit is then saying where do we find them in the digital world? Where are carpenters? Are they on Facebook? Are they on Instagram? Are they Googling? And at what point? What are the words they're using when they're looking to solve their business problem? Because our customers are smart people there, but they're not necessarily educated in how to choose software, but they're street smart, they negotiate for a living, they're good at business, etc. So we need to really understand in the UK, what are their words that they're using, and then make sure that, for example, in our digital advertising, that we're using those words and we're there for them when they're typing in those words and our ads are turning up. Then when our ads are turning up, we make sure that the landing page they see speaks their language and talks to them. And it's through a process of trial and error. And when I say trial and error, it's daily. It's not sort of weekly, monthly, quarterly. It's every single day we're looking at the return on dollars spent in the digital world and seeing which marketplaces are responding. And we track that all the way through the sales cycle. We know, for example, that if we spend $65 a lead, for example, on one segment, but we get a percentage return out the other end where they don't convert as many, that might not be as attractive as spending $300 a lead where we get a much higher conversion rate. So we track that all the way through and constantly change what we're doing. It's the world of marketing is a very dynamic market world these days, isn't it, James? It's not a case of you have your annual marketing plan and then, like you say, snuggle your TV ads in between Coronation Street. It's not like that anymore. It's very dynamic. It's hourly, daily, constantly tuning and fine tuning and then measuring it, everything going through. It's through that process where we're getting the early success in the UK that we've had in Australia and New Zealand.
And then what about people? That's been one difficulty across lots of different sectors around finding people just to run the business now, but also to help grow. Are you running into that same issue where it's the type of skill sets that you need is hard to find, and I guess linked to that is governments in New Zealand specifically, but also Australia, doing enough to help support this sector?
It's an interesting question, that last one. So on the first one, we've been able to attract a really good team. There was a good team here when I arrived as well. Myself and Scott Player, who's the go-to-market dude in our business, we arrived together. We kind of team up on this business. We found quite a good team here. Some people had to go because we didn't have those sort of jobs anymore, but and part of that is, well, what's our, we're a little company, so what's our employee proposition? What's the thing that makes people come to work for us? And we have a whole lot of, if you like, what we call BFOs, or blinding flashes of the obvious when it comes to people. It's we employ people who treat everybody equal. We employ people who rebel against micromanagement and dictator leaders. We want people with an opinion. We want to be able to push decisions down, etc. So from that point of view, I think we've got a really good team now who really understand it. So then the second question is, going forward, as we try to, for example, accelerate the development on our platform, we're going to be looking for some of those core jobs, like technology jobs. And during the pandemic, when immigration stopped during that period of time, there's a shortage now. We see that in both the supply and the price of getting, for example, developers. We have a team of developers in Manila, so that partly solves that, because we're effectively arbitraging both the wages and the availability in setting up that team in Manila. So that partly solves it for us. But I think governments are going to have to step up in Australia and New Zealand and look at this immigration question again. And unfortunately, the immigration question over the years has been tarred a little bit with a question about they're taking our jobs. But actually, we just know, anybody who's done any little bit of economics knows that immigration has been the powerhouse behind economic development in places like Australia and New Zealand. So we're going to have to get back on that bandwagon and get that going and get the right sort of people into our economies that are going to help us grow in the future.
And then Tim, on on thinking about that global expansion and for Geo in particular, some big players out there. When you think about, or do you enter these things thinking about exit? Is this something that being a listed company is sort of the journey that Geo should be? Do you think about some of these big consolidators overseas? And obviously, I'm not asking you to tell me the plan or stuff that is in action, but when you think about it more generally, and the reason I'm asking that, perhaps maybe I should say beforehand, is over the last few months, it's been amazing to see some fantastic New Zealand companies sell to global corporations. It's been fantastic for the founders, and I have massive respect for them doing that. But is that showing that the ecosystem in New Zealand isn't set up to help grow the companies from the size that they were to being on the market? Because it's, I'm a listed equity investor for our clients, and there's only so many electricity generators you can purchase, and you want some variation, you want some growth, you want some excitement, diversification, and just as these companies get to a size, they sort of absolutely fine. That's what I'll do too if I was one of the leaders of these companies, move it overseas. And any views or comments around that?
I suppose part of it is almost a no regrets idea, which is that perhaps the role of smaller economies like New Zealand is to incubate these things and actually get them to a point where they are attractive to those very deep capital pools that are available in other parts of the world. That's a good thing. That brings that capital back down to shareholders in this case in New Zealand. Perhaps that's a good thing. Perhaps that's the role, to be able to do that. In our own case, I talked about that phase 3 of optionality and where do we take the business, and our light on the hill is shareholder value. How do we create the shareholder value? So being listed might be a stage for a business like ours. And I'm not suggesting we won't be listed. I'm just saying, we have to think openly about what that is. So we look at, the American businesses like ours who are way, way larger than us and have enjoyed huge capital inflows into exactly the same sort of business as this is, but in America. And so they're going to get to a point probably in about 2 years or 18 months to 2 years where they're going to run out of growth options in the US, and they're already starting, because we're in touch with them, they're already starting to say they need to expand globally, and they look at economies and places of doing business that are stable, like New Zealand, like Australia, like the UK, as good opportunities for them to expand. So yeah, there are we keep a really close eye on that, and we're in touch with all of those people, and we look to the future like that as an option, not as a plan, but as an option. So now, bring that back to your question about Australia and New Zealand. Perhaps that's the role of smaller economies like this, is to incubate these businesses. Pushpay is a really good example of that, where you get it to a certain size, and then the next natural owner might be someone who's got access to very deep capital pools.
And I guess that's what you sort of found with MYOB. I mean, I've worked in private equity in my past careers, and the whole analysis when you look at these companies is there has to be the ability to continue to create value. And the fact that private equity are still looking at and taking up companies like MYOB even after there's huge amounts of growth. And I don't know if it's a reticent for the listed market to provide them with capital, or if it's just the fact that private equity just sees such a massive market share or addressable market that they can grow into. But it seems to be listed, unlisted, and sort of
a sort of a seesaw backwards and forwards over the life of the company. Sure, all of these vehicles, whether it's private equity, venture capital, being listed, etc., are vehicles to continue to achieve in the business, aren't they? And they're not an end in themselves, is I suppose the point I was making, for a business like ours as well.
So, coming back to the plan over the next, I guess, let's say 6-12 months, what can we expect from Geo? I guess it's the capital and the growth strategy into the UK, and as now shareholders and all our clients and people on this call are shareholders, I guess it's looking at that growth strategy and following it with interest. Would that be the right way to explain it?
Absolutely. We can expect where we achieved around a 24% growth last year. We're expecting a 40 to 50% growth this next year. We achieved around a 3.2 LTV to CAC ratio. We're looking to push that above 4 because it's just a more comfortable margin in acquiring customers profitably. And then, that's the scale idea. That's the acquire customers profitably. And then I suppose the next thing is, in the way we try to run these businesses too, James, is looking for predictability. We get into the marketplace like we did last year when we raised $2 million last year and said, this is how we're going to deploy the funds, and these are the sorts of numbers that we expect to get. And we did that, and that gives shareholders a lot of confidence then that we can do that. And that's, I think, a big part why we were successful in, in attracting the funds we've got now. And so that predictability is do that again, but just in a bigger way. Continue to do that.
Well, Tim, it's been great to chat. Look, it's great to be part of the journey of, we're so used to investing in some of these big and more established, and there's nothing against them, they're fantastic companies, big utilities and telecoms companies with their, predictable cash flow. You're probably saying that would be nice, wouldn't it? But predictable cash flow, dividends and things like that. But it's great to also start supporting some of these fantastic high growth New Zealand tech companies as they sort of seek out world or at least New Zealand, Australia and UK to begin with domination, and really appreciate you coming on and sharing your thoughts, and we'll watch it closely and perhaps we get you back in a year and see how that journey's gone and see what the next steps are.
Excuse me, James, thanks very much for having me on. I've enjoyed the conversation. And thanks to all of your participants for joining up and hearing our story as well.
Excellent. Well, thanks, Tim. And it sounds like you've got some pretty nice wildlife.
Well, it is actually. I'm so sorry. There's a big tree outside. It's full of lorikeets, and they all chirp. And so it's a very Australian scene.
I was going to say, you couldn't be more Australian. Well, it's nice to hear the birds chirping, the sun's out, and you can go to the pub. Apparently, you're allowed to stand up at the pub now, so you got to enjoy a couple of beers.
Right. Thanks, James. I'll shut the door without too.
Cheers. Well, we'll move to the next part of this morning's webinar, which is reflation. And as I said in the introduction, and I think talking to Tim around some of the prospects that GOC in the New Zealand, Australian and UK market is a really good example of some of the opportunities that perhaps weren't as attractive as they once were, or weren't as attractive over the last couple of years, because the thought of needing to do huge amounts of variation in portfolio construction and shares when the share market's increasing 13, 14% a year, every year, and they've done that for the last 10 years, you just needed to be in the market. But now Geo is a good example of identifying companies we think will have, no matter what the Fed does, no matter what goes on with vaccines or monetary policy, we'll still have a really good chance in growing because of the opportunities that company sees within their specific niche market. And that's the same for a whole lot of other companies. We think it's really starting to transform into a stock pickers market. And this is where people like Warren Buffett really get excited, because of the breadth of the market has started to increase. It's not just about 5 big tech companies, and the identification of some of these companies is where we as NZ Funds and the investment team and also our external managers are putting in the work to start seeking out these other opportunities. So what we thought we'd do is spend the next 15 minutes doing a deep dive into some of the companies that we've identified and have invested into the portfolios where we see some really great value creation opportunities. So pass it over to Mark and Andrew, and so far we've got to Mark, and what are we looking at?
Morning, everyone. Morning, James. Thanks for that. I suppose, look, as we sort of sit here in lockdown, it's a little easy to, I suppose, forget that we're a bit out of sync with the rest of the world. The reality is, for many parts of the world, they're now actually, for the first time, moving back to normal life, back to schools, restaurants are open, and they can travel pretty freely. And especially, there was quite a lot of travel over the Northern Hemisphere summer. And ultimately, that is a combination of, I suppose, sadly, a decent chunk of those populations having had COVID, but also relatively high vaccination rates. And that has meant that sort of governments are now willing to relax restrictions and start to reopen those economies more sort of freely, sort of something that more akin to what we have enjoyed for much of the last year. And again, I think we've seen it hasn't received an awful lot of news, but we did see in the last couple of weeks, so that path to reopening sort of had another boost through the announcement of some very positive trial results for an antiviral drug by Merck, and positive to the point where they actually finished the trial early on the view that they felt it was, the results were that good that they needed to move forward to the next step. And their drug, which, I won't look to attempt to pronounce it, but ultimately the research was sort of suggesting it cuts hospitalisation rates by about half for those that take it. Importantly, and I think this is probably the critical issue, is actually in pill form. So it's the first sort of oral treatment for COVID-19. There is another antiviral drug, remdesivir, and that's currently being used. And I think there are suggestions that probably has a similar efficacy. But the important point is that it's intravenous, so it is only administered in hospitals, and it ultimately means that people tend to be a lot sicker by the time they get into hospital with COVID. So from that point of view, having a pill to take actually is a sort of a pretty, or potentially a pretty important step forward to continue that reopening process and take pressure off hospitals. So, I think as we sort of talked, as James mentioned, sort of that reopening, this sort of sets the scene for reopening stocks, those companies that are actually benefit from life returning to normal, sets the scene for those doing particularly well. And for those of you who sort of read the paper that we put out, you'll see there's a chart there where we compared to the stay-at-home stocks, or those sort of businesses that did benefit from lockdowns, things like sort of food ingredients companies and gaming businesses and things like that. Those businesses did much better during the original lockdown process, and the reopening stocks struggled. But more recently, reopening have done better, and we think there's a very good chance of another wave of performance from the reopening stocks. So we thought it would be a useful time just sort of step back and sort of talk about some of the names that we're looking at that we think will benefit. So the first one I'll talk to is a business called GFL Environmental, and then I'll sort of hand it over to Andrew to go through a couple that he spent some time looking at. GFL Environmental is a waste or rubbish business. It's about 15 billion Canadian dollars, and it's got operations in Canada and the US. And oddly enough, you wouldn't really expect that a rubbish business is something you'd sort of first spring to mind when you think of reopening. But there are ultimately some kind of important benefits this business gets out of life returning to normal. The first is really just volume. Ultimately, if you think about rubbish collection, sure, your residential collection doesn't really change. That's a very stable, very defensive, reliable cash flow. But all the other activities, things like, think about concerts and large events, they all generate large amounts of rubbish. That is a part of their business that has not been there over the last 2 years. Equally, you go to any sort of SME business, panel beaters, something like that, there's always a skip out the back. And if those businesses are not operating to full capacity or not operating at all, that skip is not getting filled. So, the rubbish business actually does see quite a volume uplift as the world returns to normal. And even as we go further forward, you think about the larger infrastructure projects. A lot of those have been either on hold or on sort of low volume, and those again play into volume. The second one is sort of something we've talked about quite a lot, is that issue of inflation. And you know well from those who've been on this call that we do think that we are seeing more inflation. We expect that to continue. And in the rubbish business, generally the contracts that these companies have with either councils or with businesses tend to be quite long-term in their nature, 5, 7, even 10 years in nature. And because of that, they tend to have annual uplifts on the basis of inflation or specific costs. So strangely enough, or not strangely, but these businesses are very well placed to actually benefit from an inflationary period, because that gets built into the prices they get to charge to their customers. So it kind of has in many respects the reopening. They get busier and they get to charge more. So we see that sets a pretty good foundation for that business to have good performance going forward. With that, I might hand it over to you, Andrew, and touch on the ones you're looking at.
Thanks, Mark, and good morning, everyone. So another sector that we've looked at throughout COVID, right from the start, is airlines. And we've looked at airlines both from a New Zealand, Australia angle and looking at Air New Zealand and Qantas, but also from US and European airlines, because the dynamics, depending where an airline is based and where it primarily serves, has been quite different throughout COVID. For example, at the moment, United States and European airlines are probably flying around about 70 to 80% of the capacity that they were flying prior to COVID. Now, this reflects the fact that these markets are generally pretty well opened up. The restrictions of travel are quite small. For example, domestic US is quite strong at the moment, similar in a way that domestic New Zealand was quite strong prior to the Auckland lockdown happened. Likewise in Europe, in general, flying within Europe is pretty well opened up. So what you're seeing with these Northern Hemisphere airlines is generally it's their international flights to the Pacific, to Asia, to New Zealand and Australia, which are the weaker parts of their businesses, but outside of that, they're doing pretty well. This differs quite significantly from some of the more Asian airlines or New Zealand, Australia airlines. And a lot of these airlines are probably still only flying around about 50% of their capacity. And that's roughly what you're seeing with Air New Zealand and Qantas. And that's because the international flying portion is typically quite large for these sort of smaller Pacific countries. And also the domestic flying in various places has still been held back. For example, New Zealand, our capacity is now quite low given Auckland's gone into lockdown. And so what we do on an investment perspective in these airlines, we look at on a global basis, we look at about 30 or 40 different airlines, and we run valuation metrics based on how these companies were valued prior to the lockdown, what level of business they used to do in terms of what was their revenue and what was their earnings level. And then we take a look at what is reflected in the forward-looking valuations today. And what we've found is that there's actually quite significant variances based on the valuation that these airlines are trading at, assuming a recovered earnings level. Two examples of airlines we don't like at the moment, Air New Zealand and Qantas, and that's solely because they're trading on very expensive valuations. So basically the valuation is saying these businesses are going to be valued at or at a higher level than what they were before COVID, and assuming that all the earnings comes back in the next 24 months or 36 months. So for us, that's overly bullish, and you're relying on a bunch of things working together for the valuation to really play out there. So for the moment, we're sitting on the sideline with investments on both those airlines. But where we have found some more exciting airlines is a couple in US. So one example is Hawaiian Airlines. Now, Hawaiian Airlines is trading at levels cheaper than pre-COVID. It is also still trading with about 30% less sales. But what is exciting about Hawaii is that we think it is set to have a really big sort of revamp in its business as everyone starts to travel to Hawaii for holidays. So, for example, I know a lot of people in New Zealand, Australia, Japan, South Korea are really looking forward to holidays back to Hawaii. So we think it can actually have a very fast recovery. And given that the valuation is cheap, there's quite significant upside to the share price. Another one we like, which is a little bit different, is Southwest Airlines. Now, Southwest Airlines is one of the best run budget airlines in the world. And it has got a very, very strong capital structure. It's got a lot of cash. It's got no debt on its balance sheet. And it has basically used this COVID period as a little bit of a land grab. So when all the other airlines have been really struggled and trying to cut down costs. Southwest has actually been expanding its business and starting to fly to new routes that it didn't prior to COVID, because it's been able to basically take advantage of the fact it's the cheapest airline out there, and it was able to protect its profit levels the best out of everyone during the lockdown. So quite different to Hawaii Airlines, but equally quite an exciting investment case. And basically we're thinking the sales and earnings level from this business is going to actually significantly exceed what it was doing prior to COVID due to the additional market share it's been able to grab. So it's, we kind of stay very close to this airline sector. It's very dependent on what happens with sort of different lockdowns around the world, such as when Delta came, we actually had a position in Qantas around about 9 months ago as the world was coming down the worst part of the lockdowns, but we cut that position when the Delta variant came along, and it proved to be the right call. And likewise at the moment with our Southwest and Hawaiian Airlines positions, we'll watch them carefully, because if there is another virus spread and lockdowns come down, then we may need to sort of exit those positions. But at the moment, that's not our base case. We think with vaccination levels increasing, we're going to continue to see a general recovery, and business is going to return to normal over the next 12, 24 and 36 months. Outside of airlines, there's also a bunch of other interesting sectors, and again, both of these, or most of these, are generally linked to the world coming out of lockdowns and life going back to normal. One example was Live Nation, which is the world's largest producer and marketer of live concerts and other events. So basically, a lot of the live concerts you hear about in the US and Europe and even in New Zealand are organised by Live Nation. So this business obviously took an absolute hammering during the lockdown and basically went to zero revenue. However, what we're seeing globally is that as everyone's coming out of lockdown and got vaccination levels high, people are rushing back to live concerts and are really wanting to go to these live events. So now Live Nation is able to actually exert pricing pressure because people basically will pay anything to go to a live concert. So it's an interesting business. We don't have a position in it at the moment because we're still doing more work on evaluation. The key risk with this investment is the market is really assuming the revenue and earnings comes back much stronger than pre-COVID. So we need to do a little bit more work on this before we get comfortable. Another one which is also slightly similar is a theme park business in the US called Six Flags. Now Six Flags, it's got a lot of the same drivers as Live Nations, except the difference there is that the valuation is cheaper and the market is assuming a slower recovery in sales and EBITDA or earnings than they are for Live Nation. So that makes it a little bit more attractive to us in that sense, that it feels like we wouldn't pick up this business at a slightly cheaper level. But again, we continue to do some more work on this before we get comfortable with it. What is also interesting is just because we're coming out of lockdown and certain businesses are recovering really well, that also means that there might be some businesses that performed really strongly during lockdown that may now start to see a reversal of their earnings. So a couple of examples of businesses like this is some retailing businesses, and one that we're looking at is Bed Bath & Beyond. So basically in lockdown, a lot of people were ordering either online or click and collect on Bed Bath & Beyond, and the business did really well during lockdown. But what you're starting to see, particularly in the US, is that some of these businesses that did really well are now starting to give up their strong sales levels, and their margins are starting to come backwards. But they're also trading at all-time high share prices. Now, these retail businesses don't tend to be, usually be that cyclical, but they've gone through an incredibly cyclical period over the last 12 or 24 months. So there may be some opportunities to short sell some of these businesses. Another one which we're using right now is Zoom. So Zoom's business went absolutely crazy during lockdown. The level of sales and subscriber numbers went exponential, but Zoom's share price has really been suffering for the last 12 months because it basically got used a lot, and I think everyone got a little bit excited about the valuation of the business, and it got a little bit too far ahead of itself. So it's basically been on more or less a downward trajectory for the last 6 or 12 months. We will not be, or unlikely to be, initiated a short position on Zoom because it is a technology business, and these sort of businesses, if you short sell them, they tend to have an ability to trade up 10 or 20% very quickly within a day or two. So you have to be very careful when you short sell them. But I thought it was just a good example to point out. With those couple of examples, I might hand back to James or Mark to see if that's what I want to wrap up.
Great. Well, Andrew, Mark, thanks for that. I guess what it is showing, and not that I'm saying Andrew, Mark, we're doing lots of work prior, but there is a huge amount of volume of work being undertaken at the moment because of the amount of opportunities, and I just don't think we've seen this opportunity set. We saw it at sort of March, April, May last year, right out of lockdown, but really that was just about getting invested. Now it's about, okay, not all boats are going to rise with this rising tide, but there are huge opportunities to really generate strong returns from certain companies, and also benefit by being able to generate returns from companies that have done really well and perhaps under a little bit of pressure. So hopefully those insights gave you some insight into what we're doing at the moment around the share portfolios. And the last thing I'll finish with, just to give it some context, the share market or the MSCI and New Zealand market is our blended reference portfolio for KiwiSaver Growth and our APS and MSS and Wealth Builder Growth portfolios. And just to give it some context, our benchmark is up around about 1.9% and for the month, and our growth portfolio is up about 4.9%. So our performance of around 3%. Now it's early days; it's 18 days in 1 month and 1 month in a long year. But I guess what it does show is that deviation in returns that you can generate when you really do identify a market like this, where there's some opportunities by being more active. So on that note, we'll leave it there. Any questions or comments or views around our thoughts, then do send them in. We'll be really happy to answer questions and discuss them. Other than that, have a great week, everybody.